China has led the world in online retail for 8 straight years. E-commerce sales were up nearly 11% in 2020. But China has taken steps to increase regulations and keep some of the biggest tech players in check.
They want transparency in terms of their operations, in terms of the data that they gather, and they want to make sure that the playing field is much more even, and these companies don't take advantage.
This action has created a ripple effect on Wall Street.
Over the past month, e-commerce giant Alibaba shares have slipped more than 9% here on the New York Stock Exchange. And search engine company Baidu is down around 5%.
Analysts say investors here in New York are taking stock of the impact these regulations will have.
The impact is there. The uncertainty is what's pulling these stocks down. So at this point, it's not a great time to get in. We don't know where the dust is going to settle. At one time, it will settle, but at this point, I think it's prudent to stay on the sidelines.
Some US lawmakers are pushing to break up the biggest Silicon Valley tech companies. Google and Facebook are among those fighting antitrust suits. But some analysts say the scale of the shake-up in China is far more serious than what is transpiring in the US.
In some way, they're doing it because of antitrust concerns, but this is like a full court press, so to speak.
US traded Chinese stocks rebounded Tuesday after the US Securities and Exchange Commission announced plans to require these companies to disclose regulatory risk to traders. Some of the big Chinese tech firms could see more pain in their bottom line as Beijing seeks to ensure greater market competition. In the meantime, demand for online services is expected to keep soaring. William Denselow, CGTN, New York.